welcome back to Mutual saying it's the 7th of April 2026. It's 11:51 in the evening and it's Tuesday. Today we'll be looking at the APAC Strategic Capital Wrap, the first quarter analysis for 2026. As we look at the capital flows across the APAC region this week, we aren't just seeing a list of transactions, we are seeing a high-stake chess match, from massive outbound acquisitions by Indian firms to tactical deleveraging of Hong Kong's real estate titans. The narrative is one of calculated risks. But the central question for us as observers is this: in a market where the easy money era is long gone, what separates the companies that are successfully scaling from those who are merely struggling to keep their heads above the water? Today we are looking at the movers who are choosing to play offense while others are forced into a defense crouch. Let's dive in. So first, let's look at the new aggressors in the healthcare and agrochemicals sector. We have to start with IKS Health, Inventories Knowledge Solutions. For those who don't follow the back office of medicine, IKS is the administrative engine for massive US health systems, handling everything from clinical documentation to revenue cycle management. They're currently in talks for a syndicated loan of up to 700 million to fund the acquisition of TruBridge, a Nasdaq-listed peer specializing in community healthcare tech. This is a fascinating outbound play. We have an Indian-listed powerhouse leveraging international bank relationships to swallow a significant US competitor. So is this the beginning of a trend where APAC service providers use their linear cost structures to buy up Western market share? Well, similarly, in the agrochemical space, Cropnosis India, a major manufacturer of crop protection and nutrition solutions, is looking to raise up to 272 million to acquire Portugal's Ascensa. What caught my eye here is the pricing, an all-in rate of 16% to 70% in US dollars terms. So when a company is willing to pay 17% for capital, what does that tell you about the projected return of investment of the target assets? This is an incredibly high bar for success, signaling a growth at any cost mindset as they pivot from a domestic player to a global agrochemical contender. So in the next session, let's also take a look at the crown jewels. Beyond global M&A, we are seeing a push to tighten internal control. Oriental Rubber Industries, a global leader in high-performance conveyor belts for the mining and steel industries, is seeing its managing director, Vishal Maka, raise roughly $53 million in secured non-convertible debentures. The goal? A buyout of a 50% family stake. Is a reminder that private credit isn't always about building new factories. Sometimes it's about securing the foundation of a family-run global leader. Well, then we have the giant JSW Steel. Their subsidiary, JSW Kalinga Steel, which houses the assets of the former Bushan Power and Steel, just successfully placed over $1 billion in NCDs, non-convertible debentures, with names like Mitsuho, MUFG, HSBC on the ticket. It's clear that the Tier 1 appetite for Indian industrial expansion remains a cornerstone of the regional market. With their goal of hitting 10 million tons by production by 2030, JSW is effectively betting that the global infrastructure boom isn't slowing down anytime soon. Next, let's also take a look at the tech resource and the war chest. Moving to Japan and Australia, the focus shifts to the future of AI and energy. SoftBank Group, the global investment powerhouse, is reportedly working with JP Morgan for a 10 billion loan. The most interesting detail, well, it may be structured as a non-recourse facility secured against their shares in OpenAI. So is SoftBank doubling down on AI as its primary collateral because it believes in the valuation, or is it simply the only asset that is hard enough to secure 10 billion in this environment? Meanwhile, in Western Australia, PLS Group, Pilbara Minerals is looking at a 10.5 billion expansion of their P2000 lithium project. As the owner of one of the world's largest hard rock lithium mines, they're sitting at the heart of the EV revolution. They have been on a roadshow in Singapore and Hong Kong, signaling that while they don't need the cash today, they're ready to tap the bond markets the moment the window looks favorable. It's a masterclass in just-in-case liquidity management. Now, let's talk about the defensive side of the ball. Several major players are currently navigating a maturity wall, a concentrated period where massive amounts of debt come due. Let's take a look at China Water Affairs. The largest private water utility in China has secured a 500 million offshore quota from the NDRC to refinance the notes due in May. They're playing it smart by tapping the Asian Development Bank for Chinese yuan-dominated financing to hedge their currency risks. In the luxury sector, GPA Global, the sustainable packaging partner for some of the world's biggest tech and luxurious brands, is seeking 250 million in combined senior and mezzanine debt. With backing from Ontario Teachers' Pension Plan, they are looking to clean up their balance sheets through 2030. Perhaps the most tactical move comes from PCPD, the Pacific Century Premium Developments. Controlled by Richard Lee, this high-end developer is looking to slash its 1.3 billion debt pile by 400 million. They are doing this through a surgical combination of bond issues and the sale of assets, like their Jakarta office tower. Is this the blueprint for real estate survival in a high-rate world? Sell the trophy asset today to ensure the company's survival tomorrow? Well, however, let's take a look at however, it's not all smooth sailing. We are seeing cracks in the armor of some legacy giants. Say, for example, Shapoorji Pallonji Group, SP Group, the historic Indian engineering and construction conglomerate, has had to ask their creditors to increase their loan-to-value to cap to 40%. But when a group of this stature has to move the goalpost on a covenant, it should make every observer stop and look at their underlying assets valuations. Finally, let's look at the gamble of the year Macau. While the 2025 revenue numbers look strong at 246 billion MOP, the underlying health is fragmented. The big six operators are facing a 3.45 billion in maturities through early 2027. We are seeing a widening gap in credit spreads. While leaders like SANS and MJM are holding steady, laggards like SJM are facing a reality where the cost of refinancing their maturity wall might be higher than their current cash flow can sustain. The question for the next 6 months is, who in Macau has the balance sheets to weather a low-span visitor recovery, and who will be forced into a radical restructuring? To wrap up, 2026 is becoming a year of the credit divergence. Liquidity is still here, yes, but it has become incredibly selective. We are seeing a move toward AI-backed leverage with SoftBank, reverse outsourcing with IKS Health, and green refinancing as a safe harbor for Chinese utilities. The winner in this market aren't just those with the most cash, they're the ones with surgical precision to sell the right assets and buy the right technology at exactly the right time. I'll be watching to see how many of these deals close by the end of the quarter. It will be the ultimate litmus test for consumer confidence in the region. Thank you for listening. If you enjoyed this video, make sure to like, subscribe, comment your nonsense below, and I will see you in the next one. Thank you. Bye.